Good afternoon, everyone. I am Bharat Bhushan and I welcome everyone here in today's webinar, Ask an Expert. That is our Q&A session. So, it's right. We are post 12 today and we were supposed to have this webinar started. We are waiting for another 2-3 minutes to start this session as more of the attendees are joining us. Okay. Thank you.
Audio and video.
Am I audible? क्वेश्चन वाली शीट दोबारा से शेयर करती हूँ मैंने, ठीक है?
So I welcome everyone here once again. I believe we have a lot of attendees here. So I welcome everyone once again here. As you all know, this is a Q&A session and your questions will be answered here. But we observed from our last webinar, there were a lot of confusions and questions about bonds buying and selling process. Intermediaries involved and parties involved. So here we are going to have a small presentation about these processes and then we will proceed towards our Q&A session. As you all have the opportunity to submit questions today to our presenter by typing your questions into the Q&A box, which is available at your top bottom of your panel. You can also put up your questions in the chat box. And you can also send your questions anytime during the presentation. We will collect this and address this during the question and answer session. Now, I would like to introduce our speaker, Mr. Mayank Jain and Ms. Shali Ved. Mr. Mayank Jain has 11 plus years of experience and as a chartered accountant by trade. He is a part of India's largest debt segment conglomerate looking into the operations, bond IPOs, portfolio management services before joining our BondsIndia. And talking about Ms. Shali, Ms. Shali has done Masters in Commerce and is a seasoned professional with 5 years of experience into the capital market. Currently, she has been working into the debt market with BondsIndia at the trade desk, handling broking and institutional deals. So, it is over to you, Mr. Mayank. You can start with the presentation.
Thank you, Bharat. Okay, so there are a lot of questions coming in regarding the intermediaries and the parties involved in the trades and all, in settlement of a bond transaction. So if you could just switch on the presentation and just quickly get ahead to it. Bharat?
Yes, Mr. Mayank, there is some technical issue. Just give me 10 seconds. Mr. Mayank, we have started the presentation.
Okay, thank you so much.
Yeah.
Okay, so the agenda, one of these are the agenda on the screen that we can see. The intermediaries, the role of exchanges, the role of DPs, the difference between the DP and the broker, and the settlement process in the buying and selling of trades. So we have currently just we have summarized these as the major questions that were being asked through our Q&A portal. So we will address these issues together once, and then we can address the questions of the viewers one to one. So first, the intermediaries involved. But if you just go on to the next screen, please. Okay, so one of the big first intermediaries that involves in a bond trade is with the seller. So currently, you can buy bonds from your broker, who will give you a trade on on your screen, the similar way you buy it on equity, or you can do it through your through an online participant or through registered semi brokers, for example, like BondsIndia. So we are one of so the broker becomes your first part. Second is the prop books that people sell. So Bonds India is in a unique position where we sell bonds through a prop book as a broker, civil registered broker. We do screen trades as well. The other participants other participants would be your depository participants, which is a DP. So a DP is where you open your Demat account. So in layman terms, a DP is nothing but a bank for your securities, where in your normal bank, you deposit money in a depository participant account, you deposit your securities, and your buying and selling of securities is routed through your DP. Next participant, the next intermediary would be your exchanges. So just like BSE, NSE does equity trades, so does the exchange. So the bonds are also traded on exchanges like BSE and NSE. So there are multiple trading platforms by BSE and NSE. For example, you have your F group, where just like you trade equity on screen, you can trade your uh, bonds on screen as well. Apart from that, you have your OTC markets, NDS home platforms, where broker deals or negotiated trades are reported and settled. The last participant being your bank. So bank facilitates you to transfer your funds, and apart from that, the bank in nowadays act as your broker as well as your DP participant. Apart from these, the major linking process is handled by your depositories, which is NSDL and CDSL in India. So these are the two depositories in India under which you open an account with your depository participant. Now comes the role of exchange. The role of exchange basically is a party that helps you settle deals. So in India, the biggest problem right now is there, especially in bond market, there is no particular pattern to settle deals, especially with regards to counterparty risk. Counterparty risk basically means uh, if I'm transferring my bonds to a particular person, what is the surety that I get my money? And on the second part, if I'm transferring money to a particular person, how will I get my what is the surety that I will get my securities? So this is where the role of exchange comes in. So exchange acts as an intermediary in the sense that you give your money to the exchange, the seller will give his stocks to the exchange, and in return, the seller will give you the, the seller will transfer the securities to the exchange. Once the exchange receives both the money as well as the securities, the exchange will give the buyer the securities and the seller the funds. So both the buyers and sellers are secured in terms of counterparty risk. Now, Shelly will help us in understanding the buying and selling process.
So once the customer comes to our portal, BondsIndia.com, the first thing the customer needs to do is the KYC, which is a 4-step process, which would be done in 10 minutes. They could go and select, there are more than 4,000 plus bonds on the website. So once they shortlist and finalize which bond they would like to buy, they would discover the price of the bond and they would place the order. The minute they place the order, the deal sheet would be prepared by Bonds India, and the deal would be reported to the exchange. So the customer has to make the payment as per the settlement amount mentioned in the deal sheet to the exchange. After that, the exchange would confirm the payment to Bonds India, and Bonds India would transfer the securities to the exchange. Once the exchange would receive the securities would be transferred to the Demat account of the client, and the exchange would transfer the funds to Bonds India.
Thanks, Shelly. So again, in this case, this is the process how you buy a security. Now, in case when a retail customer wants to sell some bonds, so the process changes just in a minor pitch. So in case instead of the buyer sending money to the exchange, in that particular case, the seller has to give securities to the exchange. So in this particular trade, the seller has to reach out to his depository participant or his DP. But can you shift to the next screen, please? So what the seller will do is, in case he wants to sell a trade, so he'll approach a broker, for example, a broker or a market participant such as Bonds India, to sell his stock. If he's in need of money, or he wants to exit his position, so they will negotiate a trade and they will report the deal to the exchange. So now the buyer has to give the stocks to the exchange, and the buyer, for example, Bonds India, will give money to the exchange. So in order to transfer funds, securities to the exchange, a client issues a DIS slip to his DP. DIS slip is to elaborate that, is delivery instruction slip. This slip is like a checkbook of Demat. So you sign and write the instruction that I want to give these particular ISINs to the exchange on this particular date. The depository participant, when he receives this DIS slip, he will he will debit the client's account and transfer the securities to the exchange. Once the exchange receives these stocks, and the buyer, for example, BondsIndia, transfers their funds to the exchange. The exchange will settle these trades and give the corresponding parties their relevant dues. For example, the client has transferred his securities and the buyer has given his the money. The exchange will give the seller the money that they have received from the buyer, and in turn the buyer will be receiving the securities. In this case, the risk of counterparty risk is zero, because the exchange will not give the buyer or seller the funds or securities without receiving the counter deal. The screen in front of you is an example of a delivery instruction slip which a client has to fill out. It will require details such as your DP ID and client ID, the date on which you want to transfer the securities, the exchange at which you want to transfer the securities, the ISIN and the quantity which you want to transfer. These all details will be easily available on the on the contract note or a deal sheet that you receive from the buyer. Sorry. So for example, if you're selling something to BondsIndia will issue you a deal sheet in which it will mention all the counterparty details that are required. Details such as ISIN, the DP, the market type, security name, the quantity that is required to be filled. The client will fill out these details and hand it over to the DP, and the DP will execute the trades. All in all, this is a very simple process, but because of lack of awareness and lack of accessibility to the DP, this becomes a problem. Otherwise, all in all, it is a fairly simple process to execute. And in case anyone has any issue, we are ready to help in the same. One of the major issues currently that, okay, so the counterparty details. So what you see on the bottom right of the page is the DP details that the counterparty has to fill in the DI slip when they sign. The ISINs and quantity will be mentioned on your top right of your D sheet part. Okay. So one of the major problems now, while people try to transfer securities, people are aware who their broker is, but many people are not aware who their counterparty or their DP is. So to understand the difference between a DP and a broker, it is really important. A depository participant is where you open your Demat account, where your stocks and securities are held, whereas a broker helps you in trading the securities. There is a huge difference between a DP and a broker in the traditional sense. A broker does not have access to your securities. He can merely transfer your securities for a deal done, whereas a DP will not do any transactions on your behalf unless it is an exchange obligated transaction. A DP is like a bank where you transfer your securities, and whereas a broker acts as channel partner to do your trades on screen or OTC trades. So to put it in our day-to-day terms, people use Paytm as well as their bank account. So you make a payment through Paytm. So that will be a broker in layman terms, whereas your bank account acts as your Demat account where your securities are held. Shelly, would you like to add anything in this?
Sorry.
Would you like to add anything on the same?
No, that's fine.
Thank you. Thank you so much, Mr. Mayank and Ms. Sally here. So here we are now going to begin answering the questions submitted during today's presentation, as well as the attendees who have asked their question through the registration link. And as a reminder for everyone, you can still submit your questions through the questions panels from your control panel. Mr. Mayank, the first question is from, let me give you the question first. Just allow me. So the first question here goes to Mr. Mayank, and the question is from Mr. Venugopal. The question is from Anonymous, and the question is, what is the difference between coupon and yield, and what are zero coupon bonds? So over to you, Mayank.
So a coupon is the rate of interest that a bond pays on its face value. For example, there's a bond with a face value of 1,000 rupees and a coupon rate of 9%. So every year on that 1,000, you will receive a 9% rate of return, that is 90 rupees per year if it's an annual paper. So that is your coupon. The difference between coupon and yield is, for example, if you have purchased a 1,000 rupees face value bond at a premium, so you will be receiving the amount, the interest on 1,000 rupees, but instead of 1,000, you're paying a premium to buy the bond. So the rate of return on a 1,000 bond is 9% as per coupon, but the yield on that case would be calculated on the premium that you pay. For example, if instead of 1,000, you have paid 2,000 as the face value, as a buying premium. So in that case, your return would be yield will be 4.5%. And zero coupon bonds are deep zero coupon bonds or deep discount bonds are bonds which are issued at a discount to the face value. So 1,000 rupee face value bond will be issued at a discount, let's say at 200 rupees, 100 rupees or something. And instead of paying you interest, you will receive 1,000 rupees on the maturity of the bond. So instead of earning interest, you earn your capital. So in a zero coupon bond is basically issued at a discount to the face value. Instead of earning interest every year, you earn capital every year.
Okay. I hope the question was answered, and it was quite descriptive. So moving on to the next question, and this question is from Mr. Venugopal Menon. Why are bonds not so popular as fixed deposits, even though the returns from bonds are on the higher side? For you, Sally.
So basically, bonds are not so popular as FDs because there is lack of awareness about some bonds products. There's limited understanding about the investment in bonds, linking it to the tenure, maturity, yield. So there is lack of awareness and education regarding bond market, and that is why they're not as popular as fixed deposits. So what we do, Bonds India basically gives extensive knowledge and expertise in debt markets about investing in bonds. So if they would go to our website, our portal, BondsIndia.com, they would have a very thorough understanding of how the bonds are traded.
Thank you. Thank you so much, Sally. And now moving forward, we have a very good question. Actually, this is like fixed income with monthly payout. And there is one person sitting somewhere into the Newark. He has asked about the question. Tell me the fixed income with monthly payout. And for you, Sally.
So for monthly payout, we have so many options. Some of them are like Navi Finserv, Muthoot Finance, Shriram Transport. There's IIFL Home. Also, there's this new upcoming UGRO IPO. So that would also be having monthly payout options.
Okay. Thank you. And I believe the person from the New York, actually, you have not mentioned here the name. So I would like to just put up your contact details into our chat box. We will get in touch with you and we will elaborate you about all the papers which can give you a monthly payout here. So thank you so much for the question. Now moving on to the next question. And the question is for you, Mr. Mayank. And the question is, which type of bonds are majorly issued by companies?
So companies in general issue bonds. So the terms bonds and NCDs are used interchange, and generally they don't have a difference. So companies issue NCDs or non-convertible debentures, or debentures just to put in short. NCDs and debentures are issued primarily as are categorized in many different ways. So you can categorize it as secured, unsecured, listed, unlisted, fixed maturity, perpetual maturity, or staggered redemptions. So ideally, in India, the ideal trend is to issue secured listed papers with a face value of 1,000, which is issued to a public, which is issued to a public issue, or a higher face value like 10 lakhs or something, which is issued to a private placement mechanism.
Okay. Thank you. Thank you, Ms. Ma'am. Now moving on to the next question. And the question is again for you, Mr. Mayank. And the question is from Srikanta Kumar, from Mr. Srikanta Kumar. And the question is, are bonds are safe investment?
So, bond, any financial instrument investment, it has its inherent risk, be it liquidity risk, be it redemption risk, be it principal risk, inflation, interest rate risk. So, I mean, there is no particular mechanism to define a security as safe or unsafe. So, even sovereign gold bonds, sovereign bonds of many countries, be it developed countries like Greece, were defaulted. So per se, there is no defined criteria to define, say what are secure and what is unsecured. So bonds, ideally, when you are investing, if you do your basic research, or if you invest through a good research through a research partner, they can help you to understand the risk involved in bonds. And yes, there are secured bonds of PSUs in India, of GSEC strips, and many reputed companies which are secured and relevantly safe.
Yeah, thank you. That was quite explainable. And yeah, definitely no investment also comes with 100% safety, but definitely by investing into the bonds, somewhere into the secured bonds, you are also mitigating your risks here. You are decreasing your risk from your portfolio. So moving on to the next question. And the question is about investment idea in bonds with safety. Again, this question has come up with the safety. And the question is being asked by Mr. Manas. And this is for you, Sally. Will you please throw some light on this?
Adding on to what Mayank said about the safety, so as far as selecting a bond, in terms of safety, they can select the AAA rated bonds. Like AAA rated bonds have higher degree of safety. So like the credit rating, they can check the credit rating of the bond and they can invest accordingly.
Yes, definitely.
Also, investing in sovereign bonds, GSEC bonds, will ensure highest amount of safety compared to the other ones.
Yeah, thank you. So moving on to the next question, and the question is from Anonymous. What will be the rate of return each year? And how will I tax for investing in bonds if my income falls in 0% tax level? And this is for you, Mr. Man.
The rate of return each year in bonds would be basically at the yield at which you invest the same. There will be obviously a difference in the coupon and the yield at which you invest. For example, a bond with a 10% coupon, you might have invested at a 9% yield or 11% yield. So your rate of return will be the yield at which you have invested in the same. However, the coupon will be your, but when your, as far as the taxability is concerned, the coupon and the principal will be your primary keys when you define your taxation. So interest is taxable as a regular income, so it will be taxed according to your tax bracket, whereas your capital gains will be taxed separately. So long-term and short-term tax capital gains will be taxed depending upon the how long you have held the bonds. But in case, just to put in to answer the query, if you are falling in the zero tax bracket, so it basically which means your income is less than 2.5 lakhs, so the interest liability would not impact you, since I presume income up to 5 lakhs is exempt. So there will be no impact on taxation as far as interest is concerned. Now, obviously, there are multiple factors to factor in when you are defining a tax liability, but this is a basic answer to this.
Yeah. Thank you so much, Mayank. And the next question is again from you, Mr. Mayank, and the question is from Mr. Sandeep Mankani. And he's also asking about what are the best instruments for investing in today's market for safe and decent fixed income returns.
So, Mr. Makhani, it would depend upon your risk and reward comfort. So, if you are comfortable with taking a good amount of risk, then I mean you could invest in corporate bonds or bonds with a little lesser rating, like let's assume a rating, but you would receive a return of approximately 10.5% on this rate. I'm talking about pre-tax returns. And in case you want to mitigate your risk in its entirety as much as possible, so then you can invest in government securities, C-strips, PSU bonds with a higher rating. You can invest in sovereign gold bonds, but the return in these bonds will be not as attractive as you would want it to be. The next good option would be investing in state government guaranteed bonds. For example, there are multiple state governments which have issued bonds on which they have given a guarantee. So after state sovereign bonds issued by the central government, the next safety would be in bonds which are issued by state, which are guaranteed by state governments. So there are a couple of bonds in which the state government gives a written guarantee that in case there's a default by an issuer, the state government would repay its the entire liability in X number of days. So UP Power being one of those, issuers where the government of Uttar Pradesh has taken a liability and given a guarantee that in case there's a default, they will manage the same. These all securities do have a good amount of security, and you can invest in those. And the rate of return on this particular papers is also decent enough.
Thank you. Thank you, Mango. Well explained. Now, moving on to the next question. And the question is for you, Ms. Shali. Investment in short-term / long-term bonds with assured liquidity.
As far as liquidity is concerned, AAA bonds, PSUs are most liquid bonds compared to other bonds like REC, PFC, IRFC, NABARD. These are one of the most liquid bonds. Also, sovereign guaranteed bonds, GSEC, these are very liquid bonds, like 10-year GSEC, 635 coupon 2032. So all these bonds are very liquid bonds. AAA rated bonds are very liquid bonds compared to the other bonds.
Okay. Now, next question again is for you, Shali, here, and the question is from Mr. Rajiv. Okay. He's asking about what do you think? What is the outlook of medium-term bonds? Shall I repeat the question? Mr. Rajiv is asking, what is the outlook of medium-term bonds?
I'll take that question. So currently, given the inflation and the repo rate scenario in India and across the world, so there is an expectation that the repo rates would increase, and given that interest rate across the globe is going haywire, so currently it was presumably safe to invest in short-term bonds and medium-term bonds. Hello, can you hear me? Yeah, so investing in medium-term bonds would as far as investing in medium-term bonds, the outlook in that would be if the rate of return, the current yield matches the investor's requirements. For example, if you're expecting a 10% return in a medium term, and if the investment that you're doing currently matches the requirements, you can definitely invest. But as far as the macro situation is concerned, the outlook in medium-term bond does look a bit tensed.
Okay. I hope, Mr. Raju, your question was answered well here, and you have got a decent idea, pretty idea about the outlook of the medium-term bonds here. Now, moving on to the next question, and this question is for you, Mr. Mayank. And the question is, what would be more profitable, buying from market or apply for a new issue?
So it would totally depend on what kind of issue and what paper you're looking at. For example, there was a recent issuance of State Bank of India papers. So within a week, there was a 1% depreciation in the price of a bond. And whereas there are multiple issues where tax frees or any other state guaranteed bonds were issued, the day after the listing, the bonds had a 3.5% gain in principal terms. So it totally depends on what issuance you're buying. In an ideal scenario, yes, it was obviously preferable to buy in public issue because you know what price you're buying it at and you're committing to the yield or the returns that you're investing it at.
Okay, thank you. Thank you for your answer, Mayank here. Moving on to the next question, and this question is from Anonymous, and this question is for you, Sally. Best recommended bonds with 9% plus returns with monthly and quarterly interest.
So 9% plus returns with monthly and quarterly. So they can go for 920 Navi 920 Navi FinServ 2023. That is around 9.8% yield. There is 1025 Shriram Transport, 960 IIFL. So these are the coupons and the bonds I'm talking about. 960 IIFL, they can go for that. There's Muthoot Finance, 1026 Muthoot. So these are all high yielding bonds, which are monthly coupons.
Okay.
Yeah.
Thank you for suggesting these papers. And if you have any questions, I don't know, you have mentioned you have not mentioned your name here. So if you want to know further about these papers and all the investment options available as per your requirement, you can get back to us through our portal www.BondsIndia.com as well. Okay. So now moving on to the next question. And again, this question for you, Shally. How is possible to create a sustainable income from the bond market?
So for sustainable income, what they can do is you need to choose from the combination. There are different maturities like short term, medium term, long term. So again, choosing from the 10 years, 1 year, 2 year, 5 year, which coupon, which maturity you would like to go for. There is monthly option, interest payment options are monthly, quarterly, half yearly. So depending upon the risk profiles, you can choose accordingly, like about the maturity and the coupon options.
Okay. Yeah, definitely. Thank you. Now moving on to the next question here. And this question is for you, Mr. Mayank. Is investment in bonds reliable for liquidation of cash in view of bonds market growth in secondary market?
Okay, so liquidity in bonds was a very big issue in the till recent past. So, for example, I would say like in 2017, 2018, liquidity in bonds was a genuine issue. But in the coming years, there have been multiple government efforts to bring liquidity and retail investment in the bonds market. So there have been multiple platforms by multiple exchange platforms that have come up which have helped retail to invest in bonds. So and there have been multiple upcoming platforms So similar like Bonds India, we are so in case you wish to sell a bond in the secondary market, then you have multiple options. You can approach us directly with whatever requirement you have, and we will be easily help. One of our team members would help you to liquidate your bonds. So as soon as you give us the security, we'll give you a valuation, and on any tradable day, for example, if you approach us today and it's a tradable day, and if you agree with the codes, we can do a trade on the same day on ICCL platforms, provided the value of the same is in excess of 2 lakh rupees. Or do we have other sources as well to sell the securities? So liquidity, as far as bonds is concerned, it most of the bonds which are regularly traded can be sold off and money can be received in 1 to 3 days.
Yeah. Thank you for your answer. Now, moving on to the next question. The question is from Ms. Ankita. And she is asking, sir, in present context, where to put money in bonds? Short duration, medium duration, or for the long duration? My age is around 35 right now.
Okay, so it would, given the current lady's age, so the investment can be spread across all 3 avenues, all 3 durations, short term, medium term, and long term. So you can invest in bonds with short-term maturity to meet your immediate investments and day-to-day expense needs, and you can invest in long and medium term to support your future growth. So in case you want to invest, you can invest in bonds with a short-term maturity like Hugo Capital, Navi Finserv, India Bulls, which have a mature papers in which the maturity is between 1 to 3 years and earn a decent amount of return. I presume the current levels would be in the range of 9 to 11%. Piramal Capital is another good example in a long-term investment option. So Piramal Capital has a maturity of 10 years, so it will help you to generate a 10 to 11% return over the next few years.
Yeah, thank you so much, Manga. And I believe you totally said correct. And this also depends upon the fact, like, what is my actual goal? If I am putting my money for another, if I'm looking something, a return of around 8 to 10% and want to invest for 12 months or 18 months, then definitely I should go with the short term, and accordingly can go for the medium and long term bonds. So thank you so much. Now, and I hope Ankita has got her answer. Miss Ankita has got her answer. Now, moving on to the next question here, and this is for you, Shelly. And the question is, how can bonds be used as an asset to generate income to take care day-to-day life?
How can bonds be used as an asset?
Yeah, I am repeating the question.
Yeah.
How can bonds to be used as an asset to generate income to take care day-to-day life?
Okay, so basically, income from bonds. So again, it depends upon where you are investing, which maturity you are choosing. So especially if you are taking the coupon, monthly coupon, whether you're taking the quarterly coupon, if you're taking the monthly coupon, you would be paid interest monthly on that. If you're taking annual coupon, then you'll be paid annually. Also, again, depends on the safety of the bond. So if you're going for AAA secured bond, that is going to be safe. So depending upon the maturity and the coupon, they can decide that which bond they would like to invest in, and also the safety of the bond. They can check the credit rating of the bond and accordingly make the investment.
Thank you, Sally. Now, moving on to the next question. The question is for you, Mr. Mayank. Actually, you want to know how to buy and sell, and when and which bonds to buy.
Can you repeat the question, Brad? I'm so sorry.
And the question is, client wants to know how to buy and sell, and when and which bonds to buy.
Okay, so I'll break this question into 2 parts: how and which. So how to buy bonds? Okay, so the process would be simpler. You can share contact details with one of our representatives or in the chat box. Our representative would definitely assure you in choosing which bonds you want to buy, depending upon your risk factors and your investment requirements. Now, how to buy bonds? Okay, so once you get in touch with one of our representatives, you can he'll help you in doing your KYC on a portal. It is a 100% paperless KYC. You can log into a portal even if you don't directly, or you can ask one of our representatives to help you. Once your KYC is through, so they will be asking you the basic details such as your bank account details as well as your Demat details, where the bonds are, where your money and your bonds will flow. Once your KYC is done, the deal representative will get in touch with you to understand your requirements, or you can go through our website and you can choose from a multiple list of there's a multiple list of bonds which you can choose from. So it depends on what kind of security, what kind of a rating that you're looking for, what kind of returns you're looking for, or what maturity you're looking for. So you can choose whichever bonds you want to buy, or you can ask our representative will help you in that case. Once you choose your bonds and you confirm a deal, the deal will be reported to an exchange. Once the deal is reported, you will have to transfer funds to the exchange, and we will transfer the funds to the exchange. Once the exchange receives the funds as well as the securities from us, the exchange will give you the bonds, and the exchange will give us the funds only after confirmation that we have given you the securities. So in that case, there is no risk of counterparty default. As for example, there wouldn't be a case that you have given the funds but you have not received the bonds.
Thank you, Mr. Mayank. And proceeding further, actually, I want to add on here, like anyone who wants to put here the questions, you can put your questions into the Q&A pane from your screen. So you can put up your questions there, and we will bring that questions for you during this session. So moving forward, the next question is again for you, Mr. Mayank. How do we evaluate the right price of the bonds once it is listed in the exchange, and how liquid are these bonds?
Okay, so I presume this has come from a retail investor. So how do you evaluate the right price of a bond? So as far as retail investors is concerned, the right price for a retail investor would be at what yield would he like to invest his funds. If that particular yield which is currently traded at matches the client's requirements, then it is the right price for him. For example, if I am investing, I want a 10% yield or 10% return over the next 5 years. And if the current exchange rate, current prices matches the same, then it is the right price for me. Otherwise, if you, as far as this is as far as the retail investors are concerned. But if this is a corporate or any other concern, then I would definitely not give the same answer, because that wouldn't be helpful in the same. But yeah, as far as retail investors is concerned, and to an extent, in the masses in general, if the price matches your current investment, your return objectives, that would be the right price for you. And as far as how liquid are these bonds, so you can find out how liquid a bond is based on how much quantity of the bonds is getting traded every day. So whenever this bond is listed, let's assume it's listed on BSE or NSE, you get how much quantity is traded every day. So you can understand the liquidity from that. As far as PSUs are concerned, I mean, PSU bonds are really liquid. So you can, I mean, liquidity in that PSU bonds is never been issued in India because of security it provides. And just to add another, I mean, bonds with a face value of 1,000 and a good credit rating are one of the very liquid bonds in India.
Thank you, Mr. Mayank here. So moving on to the next question, and this question is for you, Sally. Is investment in bonds reliable for liquidation of cash in view of bonds market growth in secondary market. So I repeat that question. The question is
Yes,
all about,
please.
the question is all about, do the investment in bonds, are the investment in bonds reliable for liquidation, looking into the current scenario of the market?
Yes, investment in bonds are reliable, very much reliable, depending upon the liquidity. Most of the AAA bonds are liquid, highly liquid bonds, PSUs like HUDCO, NABARD. So if invested in the highly liquid bonds, then even the GSEC and the sovereign bonds are very liquid bonds. So investment in these bonds will always assure that there is liquidity as far as these bonds are concerned.
Okay. So here, I hope all the questions asked from the registration during the time of the registration has been answered. Now here are some live questions which all the attendees here, you all have asked from us. So I will be taking up the questions one on one. So Mayank and Sally, we are starting with the live questions here, okay? And the very first question is from Mr. Cody. How can I make career in bonds? And is there any partnership program with Bonds India? And this question is for you, Mayank.
I'm sorry, you will have to repeat the question for me. How can I make a career in bonds?
Yeah.
Okay, so I presume the question is not as far as investment is concerned. The question is as far as employment is concerned. So yeah, there are multiple agencies in India who trade in bonds. So you can join any of them, Bonds India included. So yeah, career in bonds, and you would be really you will need to check your maths first and your investment ideas. Partnership program with Bonds India. I mean, I'm not sure where this question is coming from, but yeah, you can connect with us offline, and we can definitely answer your queries, because this question is a bit, I mean, unclear what the objective of the question would be.
Well, I believe Mr. Cody has asked something like, is there any partnership program with Bonds India? Then I think, I hope the answer, it has been answered here. And moving on to the next question. And the question is about depository participant, that how ICICI Securities, ICICI Bank, and the depository participants NSDL or CDSL are different for you, Mr. Man.
Okay, so I presume this question we have already discussed this question. So so this is a difference between a broker, a DP, and a depository. So ICICI Security would be acting as your broker, whereby he would be executing trades in your favor, buying or selling trades in your favor. ICICI Bank DP would be where your securities are actually held. For example, if the broker you want to sell some of your securities, the broker would ask your DP to give the securities to the exchange to sell those. And NSDL and CDSL are two depositories under which DP participants registered. So the structure would be NSDL, at the top of it, under it comes ICICI Bank DP, which is connected to ICICI Security as their broker.
Okay. Thank you so much, Mr. Man. Now, moving on to the next question, and the question is for you, Shelly. And the question is, why Bonds India when we have other platforms for bonds trade?
Okay, so with Bonds India, we have on our online portal, if you would go on BondsIndia.com, there are more than 4,000 bonds listed there. So you can go there, and there is a detailed description about each bond. Plus, there's a calculator wherein any particular bond which you would like to invest in, it would give you the exact amount at what you would receive, what returns you would receive at maturity. Secondly, as far as the payments are concerned, everything is very swift. It's an online procedure. So it's just a 2-minute thing that you can just buy your bonds and make your payment online. So the process is very simplified. Because everything is online and it's very tech savvy. Plus, the details about bonds, each and every bond is listed on the website. So with complete information with IM and everything.
Yes, definitely. Definitely. That is what we are making or bringing the difference into the market and other platforms, apart from the other platforms. So moving on to the next question. And the question is from Mr. Harsdev Chaudhary. How we calculate the accrued interest? Do we take 360 days as a base or 365 or what? And this question is for you, Mr. Man.
Okay, so for each security, ideally it is mentioned in the information memorandum or the term sheet of the issuance. As far as corporate bonds is concerned, 99.99% is 365 days, 365, 366, depending upon what tenure the bond is and whether leap year lies. But yeah, so it is 365 days for all majority of the corporate bonds in India.
Yeah. Thank you. And again, the next question is from Mr. Cody, and for you, Mayank only. The DIS is a very old way. It is very obsolete now. Nobody uses it nowadays. Then why are we using it?
Okay, so DIS is a very old way. So DIS slip signing is one of the ways in which retail participants do trade. Not everyone does have an access to a speedy network. And I say speedy, it's one of the platforms by NSDL, which allows you to transfer security. Retail investors per se do not have access to speedy. For that matter, even EDIS they do not have access to. There are multiple ways of transferring, but as far as retail investors is concerned, DIS slip is one of the simplest and easiest way to do transactions. It is obsolete, but it is one of the most effective manners to confirm a trade as far as retail investors are concerned. As far as corporate or institutional investors or HNI clients are concerned, there are multiple options. For example, EDIs can be issued. You can use NSDL Speedy or CDSL's platform to transfer securities online. There are definitely ways to do that, but retails wouldn't be having access or wouldn't know how to, for the lack of awareness and lack of training, wouldn't have a clear idea on the same.
Okay, thank you for the answer, Mr. Mayank here. Now moving on to the next question. And the question is from Mr. V. Is gain on zero coupon bond taxed as interest or capital gain? Over to you, ma'am.
So, Bharat, the taxation queries really wouldn't be this platform wouldn't be the right platform to answer taxation related queries. Yes, this is one of the most important confusing questions in the entire platform. But yeah, as far as if the securities are sold before maturity, there's a difference on the capital gain tax transaction. If it is sold before the maturity, the taxation treatment is different, and if it is sold before after the so if the bonds are allowed to mature, the taxation different would be different. But this question is not, this platform is not for that particular discussion.
Yeah, definitely. So I would request to Mr. V that you can put up your contact details into the chat box here, or you can contact us. We will get back to you by having all the details about the taxation and all the parts of your investment into the bonds. So yeah, now moving on to the next question. And the question is from Mr. Chakrabarti. What are risks in secured bond? What are risks in secured bond? Should we always look into AA credit rating at minimum?
Okay, I'll take that. Yeah. So what are the risks of secured bond? So any financial product has inherent risk. Should you look at AA credit rating at minimum? So there is no minimum criteria. I mean, there are bonds which are rated A or A minus for the matter, which have never defaulted and which have a good credit history. And there have been bonds in the past which had a AAA rating, but yet they have defaulted. So credit rating alone will never be a criteria to confirm. But yeah, it can be, you can give it at a significant weightage while you make an investment decision. So if I am a retail investor, I would look at the company's past performance, the performance of the company's, would you would say, equity side of the company, equity share price of the company that's listed. Otherwise, you can look at the quarterly compliances of the company, the SEBI in an exchange notifications that the company publishes. But yeah, anything above an A is an investable security. But yes, other criteria do matter.
Okay, thank you for the answer. And the question is from Mr. Harsdev Chaudhary. And this is for you, ma'am. Why bonds having good credit rating trade on discount?
So again, it is a bond while with a good credit rating is traded at a discount. Okay. So it is again not exactly rocket science to define at what price a bond will trade in the future. So for example, an issuer has issued a bond at let's assume 100 rupees. But if the market feels that the return on this particular bond is not the expected level, the markets will take it to a level which they feel is relevant. For example, let's take the SBI issue that had happened a couple of weeks back. So the bond at a bank like SBI, which has a really good credit rating, I mean, within couple of days after listing, the price of the bond went down 1%. So as far as a percent in bonds is concerned, it is a pretty big drop. So there, bonds trading at a discount or trading at a premium, it would not be the exact criteria to define your requirements. It would, the yield at which the bond is trading at would be a better judge of the price of the bond.
Yeah, thank you so much for the answer. And again, here the question is from Mr. Keitha Siran. And the question is, are we segregating secured bonds based on its credit rating, or is there any other parameter there when we say a bond is secured? Basically, what is the difference between secured bond and an unsecured bond? Over to you, ma'am.
So credit rating is one of the factors that the bonds can be segregated. Apart from credit rating, there would be a maturity. Even there would be secured and unsecured pay. Security would be one of the issues on which asset the company is securing the bonds with. For example, a finance company would be securing the bonds against the future receivables, or it would be hypothecating the assets against the security. So segregation of bonds can be done on the credit rating, the security type, if it's secured or unsecured, if it's listed or unlisted, if it is a perpetual bond or if it's a fixed maturity bond, if it's a monthly coupon or what's the IP frequency of the bond. And the difference between secured and unsecured bond would be a secured bond in case of a default, you would have some claim on the assets of the company. When I say some claim, so whenever a bond is issued, there's a hypothecation of charge against a particular asset of the company. So in case there is a default by the company, the bondholders can approach the trustee. There is a good process in it, but the trustee, debenture trustee will get in touch with the company and will create a charge over the assets and release the money. As far as unsecured bonds are concerned, the risk is a bit higher in case there is a default by the company. So there is no security, no specific asset from where the issuer can, the bondholders can get their funds. So it will be in a general charge for the entire assets of the company.
Thank you, Mr. Mayank here. I believe, Mr. Keeta Siran, you have got your answer. And over and above, if you want to discuss furthermore, then you can put up your contact details. We will get back to you in no time. So there is one very interesting question, and here the name is not here who has asked this, but the question is, what if bond is sent to a wrong depository or to a wrong Demat account?
I'm sorry, can you repeat the question?
And the question is, what if bond is sent to a wrong Demat account?
Okay, so that would be a genuine problem which is encountered in India. This is a market-wide phenomenon. If the bond is transferred to a wrong Demat account, that particular problem needs to be addressed by the depository, the DP participant, depositories, and the counter DP. In case the counter DP is cooperative, then you really wouldn't have any issue. But yeah, getting a bond which is transferred to a wrong Demat account does involve quite a lot of process and to and fro, and it would require a lot of patience.
Thank you for the answer. And now here the question is again, no, the question is from Mr. Girish Mutkal. And he's asking how ICICI Security, actually he's mentioning here ICICI Security as a broker, ICICI Bank as a DP, and NSDL CDSL as a depository. So the question is, how ICICI Security, ICICI Bank, and NSDL/CDSL is involved in selling bonds? Please explain the selling process again.
Okay. So ICICI Security as your broker, if you're doing a trade with BondsIndia, I'll start the question from that perspective. If you're doing a trade with BondsIndia, ICICI Security as a broker would never have a role in this. So when you're trading with BondsIndia, you will not have to pay any brokerage to us or ICICI Security, because there's a direct deal between me, BondsIndia, and you. So between BondsIndia and the client, there is no brokerage involved. So there is no role of the broker. As far as the DP is concerned, ICICI Bank DP. So the client will have to give an instruction to the DP to transfer their bonds to a exchange account from where the client will get this money in case the client wishes to do transaction with us, with BondsIndia. So the DP will transfer the bonds to the exchange. BondsIndia, as a buyer of your bonds, will transfer the funds to the exchange, and the exchange will settle the deal and give you the funds. And after the funds are received to you, they transfer the securities to us. The role of NSDL CDSL, as far as the retail client is concerned, ends at the DP end. So the interaction by the DP will be with NSDL CDSL and not the retail client.
Thank you. And we have already discussed this in our presentation as well. And I hope, Mr. Girish, you have got your answer. If further you have any query, you can contact us. So this one is, as we know, we are moving late in our session. We are on 1:13 here. So we are taking up the last question here. The question is from Mr. Chakrabarti again: is cumulative interest payment frequency better for you, ma'am?
Cumulative IP is better. Okay, again, this would depend upon the portfolio, the requirements of the client. In case you want a regular interest, or if you to support your day-to-day expenses or to manage your day-to-day activities, a regular interest would be preferable. In case if you want, or if regular funds is not your objective, then you can go for an cumulative frequency.
Okay. So thank you everyone here, and thank you Mr. Mayank and Ms. Sally here, and for everyone who are attending our webinar here. We have tried to answer as many questions during this time. Many questions were repetitive. Many questions were like their language were different, but the answers were the same. So I have skipped that questions because we have already answered those. Still, if someone has any questions or queries, they can post their contact details in our chat box. We will get in touch with them. If you have further any questions, the same process you have to do. You can either visit our portal www.bondsindia.com. You can directly chat on there, and a representative will get back to you with the answers. And here I would like to request everyone to please submit your feedback, which you have posted in our chat box. And I would like feedback link posted in our chat box, and it would be highly appreciable if you would complete that and provide your feedback. So here on behalf of Bonds India, I, Bharat Bhushan, and all my presenters, thank you everyone for joining us today, and have a great day ahead. We will come again with such insightful session in near future as well. And we would extremely love to address you all again and again by clearing your doubts. So thank you so much once again. Thank you.
Thank you.
So thank you so much, Mayank and Sally. Thank you for conducting this session and making it use it. There were a lot of questions we have. So thank you so much.
It was a pleasure. Thank you so much.